The recession storm. All signs are pointing to an economic slowdown. Inflation is still sticky. Interest rates remain high. Job markets are cooling. And debt levels are at record highs. Economists around the world are warning about a possible recession. So the question is, what should investors do right now? Panic? Sell everything? Or position themselves wisely? Let's break it down step by step. First rule, don't panic. The first rule in any recession is simple. Don't panic. Markets move in cycles. Boom and bust are part of the game. If you sell everything out of fear, you often lock in your losses. The investors who get wealthy are the ones who stay calm. History proves this again and again. During every past recession, markets eventually recovered. And those who held on or even bought more made huge profits later. Build your emergency fund. Before talking about investing, let's talk about survival. The smartest investors make sure they are financially stable first. That means building an emergency fund. At least 3 to 6 months of expenses in cash or savings. This safety net protects you if you lose your job or face unexpected costs. Without it, you might be forced to sell your investments at the worst time. Cash gives you flexibility. And flexibility is power in a recession. Reduce bad debt. Another step before investing is reducing high-interest debt. Credit card debt. Personal loans. Anything that costs you 15 or 20% in interest. Why? Because no investment can reliably beat those interest rates. Paying off high-interest debt is like getting a guaranteed return. And in a recession, the last thing you want is heavy debt dragging you down. Strengthen cash flow. Recessions often bring layoffs and income instability. So focus on strengthening your cash flow. That means cutting unnecessary expenses, finding side hustles, or diversifying your income streams. The more stable your cash flow, the less you will fear market downturns, and the more confident you will be when opportunities arise. Defensive stocks. Now, let's talk about investing strategies. One of the smartest moves in a recession is shifting toward defensive stocks. These are companies that provide essential goods and services, utilities, healthcare, consumer staples like food and cleaning products. People still need these things even during a downturn. That makes these companies more stable than luxury brands or travel businesses. Defensive stocks help protect your portfolio from extreme swings. Dividend stocks. Dividend-paying stocks are another smart play. Why? Because they provide steady income even when prices are down. Many strong companies continue to pay dividends through recessions. And reinvesting those dividends helps you accumulate more shares at cheaper prices. Dividend income can act like a financial cushion during tough times. It keeps money flowing into your pocket while you wait for recovery. Bonds and treasuries. Another safe haven is government bonds and treasuries. They may not give explosive returns, but they provide stability. In fact, during recessions, money often flows into bonds, which pushes their prices up. Owning bonds can balance out the volatility in your portfolio, especially short-term or medium-term bonds. They give you income and safety. Gold and precious metals. Gold is also worth considering. When fear rises, gold shines. It doesn't always go up, but historically, gold has been a hedge during uncertainty. Adding a small percentage of gold or precious metals can provide balance, especially if inflation remains high while the economy slows. Don't abandon growth completely. Now here's the mistake many investors make. They sell all their growth stocks during a recession. Yes, growth stocks can fall hard when the economy slows, but recessions also create opportunities. Strong companies with solid fundamentals often bounce back even stronger. Think about tech giants after the 2008 crash, or innovative companies after the 2020 pandemic dip. If you have a long-term horizon, don't abandon growth completely. Look for discounted opportunities. Dollar cost averaging. Timing the market is nearly impossible. Nobody knows the exact bottom. That's why dollar cost averaging works so well. Instead of trying to guess, you invest a fixed amount regularly, whether prices are high or low. Over time, this strategy reduces risk and builds wealth consistently. During recessions, this means you are buying more shares at cheaper prices, which sets you up for big gains in the recovery. Diversification is key. Never put all your money in one basket. In a recession, diversification is protection. Stocks, bonds, real estate, gold, and even some cash. A mix of assets ensures that no single downturn destroys your portfolio. Diversification doesn't eliminate risk, but it makes your financial future much stronger. Focus on quality companies. In tough times, weak companies collapse, but strong companies survive. That's why you should focus on quality businesses. Look for companies with low debt, steady cash flow, and strong demand. These are the businesses that can survive a downturn and thrive afterward. Remember, recessions separate the strong from the weak, and you want to own the strong. Real estate in a recession. What about real estate? Recessions can cool the housing market. Prices may fall as demand slows, but this also creates opportunity. If you are financially stable, a recession might be the best time to buy property at a discount. Just make sure you don't over-leverage with too much debt. Real estate can be a powerful long-term wealth builder if bought wisely. Keep emotions in check. The biggest danger in a recession is not the economy. It's your emotions. Fear makes people sell low. Greed makes people buy risky assets hoping for quick profits. Smart investors learn to control emotions. They follow strategy, not panic. Because emotional decisions destroy wealth. But disciplined decisions build it. Learn new skills. Recessions aren't just about protecting money. They're also about growing yourself. When the economy slows, competition for jobs and opportunities rises. Learning new skills increases your value. Whether it is tech, finance, or entrepreneurship, a recession can actually be the best time to level up. And those new skills will pay off for the rest of your life. Look at the big picture. Remember, every recession in history has eventually ended. The Great Depression, the 2000 dot-com crash, the 2008 financial crisis, the 2020 pandemic crash. Every single time, markets recovered and reached new highs. The investors who stayed disciplined built massive wealth. The ones who panicked missed the opportunity. So look at the big picture. Short-term pain leads to long-term gain if you stay the course. Final thoughts. Recessions are scary, but they are also opportunities. They test your patience, your discipline, and your mindset. If you prepare wisely by building cash reserves, reducing debt, diversifying investments, and staying calm, you will not only survive, but thrive. The greatest wealth transfers in history often happen during recessions. The question is, will you be ready? If this video gave you value, hit the like button. Subscribe for more strategies on money, and investing, and building wealth. And share your thoughts in the comments. How are you preparing for the next recession? Your strategy might inspire someone else.